Hello, everyone, and welcome back to another video here on the SNS Capital Group YouTube channel. My name is Steve Seger, and I'm the Director of Acquisitions and Investor Relations here at SNS. Today's video is going to be covering a very popular topic with real estate investing, and that is taxes. So I'm going to be joined by Phil Weickert, who is a CPA and partner at HW CPAs here in Cincinnati. Phil's practiced in tax since 2011, and he's been a real estate investor himself since 2013. And he focuses much of his practice on helping real estate investors navigate their tax returns. And disclaimer here, Phil and his team also prepare the SNS partnership tax returns and investor K1s. So he understands these investments from both the CPA's perspective and the investor's perspective as well. So, in this episode, we are going to follow a hypothetical investor who is his name's Jordan, and he's going to put $100,000 into a apartment syndication opportunity, doing a value add business model. We'll dig into it a little deeper here in a minute when I bring Phil on, but we're going to explain what to expect from a K1. We're going to talk about cash flow and taxable income and why they can look different. We're going to cover depreciation, cost seg studies, creating those paper losses for you as a limited partner investor, how to use those losses, and really what sort of questions and general things that you should know as a limited partner investor. So, disclaimer, this conversation is for general educational purposes and it's not personal tax advice. Every investor's circumstances are going to be different depending on their situation. So be sure to consult your own CPA or tax advisor. But without further ado, let's jump into my conversation with Phil Weickert. Phil, welcome to the show. How are you?
Good, good. Steve, thanks for the invite and glad to talk about taxes today. No, doing well. How
Yeah,
are you
yeah.
doing?
I'm doing good. I appreciate it. I got my coffee in me. I'm feeling good. I'm ready to talk through taxes. I know this is a very popular topic with our investors, and I'm excited to dig in today. And I wanted to start first with giving you the opportunity to share a little bit about your background, just so the listener here can understand who you are, where you've been, and what you've done.
Yeah, yeah. Well, first off, you should probably get a second cup of coffee because taxes usually put people to sleep. But I'm Phil Weickert. I'm a partner at H&W CPAs. H&W CPAs has been around since 2021, but I've been practicing tax since 2011, and so it's one where I became a real estate investor myself in 2013, and really just found a passion for real estate. And then when I was working for a big company, and when people started asking me questions about the tax law, I got excited about helping. And so, after about 6 years of working for someone else, I started my own practice, primarily concentrating in real estate investment. One, because I was learning for myself, but two, I love just helping anyone that was making decisions, from the individual to the small businesses. And that's where H&W is today, where I primarily work on real estate investors' returns.
Yeah, yeah. And to give a little background too, Phil actually files our K1s here at SNS and prepares our taxes for us. So we're very grateful for all that Phil does and all the hard work from his team as well.
Appreciate that. Appreciate that. It's nice to hear the good side on the tax piece too. So thank you.
Yeah. And Phil, we talked about this up front, but to the listener here, the way that we're going to structure this conversation is to give you a hypothetical investor, and we're going to walk through from start to finish what it looks like investing in a real estate syndication, the kind of things that you probably will be wondering, what you should know from Phil's standpoint. And we'll go all the way down to when the property actually does sell and what to expect on that end. So, Phil, I'm going to walk through this hypothetical profile that we got. Our investor's name is Jordan. He is a high income W 2 employee. He is not a real estate professional, which we'll dig into why that's important here in a second. Jordan is going to invest $100,000 into a value add apartment syndication opportunity. And he is expecting to receive roughly $7,000 in cash distributions in the first year. So that's roughly a 7% return in year one. Now, when he gets his K1 at the end of the year, which I will dig into what that term means in this video as well, he might see a tax loss. Um, we're going to use Jordan's example to understand a bunch here how cash distributions work, how taxable income plays a role here, where those paper losses that I mentioned might come from, and how you can actually use those as an investor and a W 2 professional as well. Um, so let's jump right in here, Phil. My first question is: with Jordan investing $100,000 as a limited partner here, from a tax standpoint, what should he expect over the course of that first year? What does it actually look like?
Yeah. So from the tax standpoint, you're really you're getting a K1. And so a K1 very simply is going to be like a W-2, a 1099. Pretty much it's a document that's sent to the IRS with your information on it. So that way you can get it recorded to to your account. But you're getting that K1 after the first year. And that K1, the reason you're getting K1 is the partnership files a return that is a pass-through return, aka the K1 that goes to your individual return. And that K1 has lots of boxes on it, more than like your W-2s or some of the 1099s. But really, it's going to show your income, your loss, deductions, credits, distributions, and any capital account activity.
Mhm. What sort of timing issues should a limited partner investor like Jordan expect? I mean, I know personally that not every general partner is able to get their returns out in an as timely manner. Can you expand on that a little bit?
Yeah, yeah. Yeah, so business returns are due March 15th. Individual returns are due April 15th. Now you can extend returns so for businesses, that extension is 6 months to September 15th, and then individuals is till October 15th. Extensions aren't a bad thing. The key is you want to work with your CPA to make sure you don't owe anything by April 15th if you have to extend. But there is no, like, I've heard a lot of fear on that, hey, my audit risk goes up, or I'm fearful of extending. That's all is not true. Actually, there's more studies showing that you're actually more likely to have less audit risk if you extend. Uh, but it hasn't been fully proven. There's studies out there. But that said, I would say a typical investor, you one of the questions, and we might talk about this later, but like you should be asking, like, hey, when should I get my K1? I would say the first year for a new syndication, it might be a little slower and then it speeds up. But I would say most that I see is going to be that June through September is going to when you're really going to receive that K1. Now there are quite a bit that get done ahead of time. One of the goals we set with SNS is to have it done. Internally we set it for early March, but by that March 15th deadline, that's always our goal. And so, so from our standpoint, from SNS, it's different. But like, if you're going to be investing in syndications, it is probably best to expect an extension. Um, and it's not that they're pushing it off because they don't want to do the return. It's there's a lot of moving pieces. There could be cost segregations, which we'll talk about later. There could be some capital issues, loan issues, depending on how big the syndication is. They actually might have to go through audits, which the audit is more for the lender's purposes. And so there's just a lot of moving pieces that aren't as simple as saying, hey, you're getting a W-2 by January 31st. We're going to have the K1 by January 31st. But that is a key question. If you're, hey, I have to file by April 15th, please talk with your syndicator about that.
Mhm. And for Jordan, let's say that he has a CPA that he works with, who is, I'm sure, aware of what a K1 is. Is it as simple as just downloading the PDF that gets sent to you, or going into your portal and pulling it and sharing it with your tax advisor?
Yeah. So from a high level, yes. However, um, if you're getting it mailed or getting it downloaded, because I've seen all sorts of things, the key is provide that entire packet. And the reason I say that it's important is I've seen people just provide the page one of the K1, just like a W-2. Hey, I just provided that because that's where all the numbers are. Well, realistically, those attached statements are really important for your CPA. So, like in SNS's standpoint, we provide the PDF, and then you're able to download that. And I probably also should say I'm an investor too, so I got to experience from the SNS standpoint as an investor, and so I get to see how the investor gets to receive the K1s and everything like that. So the key is provide that entire packet to your CPA. But if you're getting it mailed or anything else, don't just scan the first page, scan it all. But if you're working with, so in Jordan's case, he's already got an established CPA. But if you're going to a new CPA, you're going to want to make sure you provide more information. And what is that? Potentially consider your prior year suspended loss schedules. Some tax returns will provide a carryover schedule. That's going to be, good enough. But then as a new CPA or existing one, you will also want to let your CPA know, hey, did I put any more capital in? So capital calls or major distributions. Was there any sale or refinance notices that you knew about? And then if this is the first year working with a CPA, you want to provide those original investment documents, not necessarily the whole thing, but like, hey, how much did you originally put in? Because basis becomes important, which we'll kind of talk about that a little bit later. But those, again, just depending on where you're at with your CPA, provide as much as possible because it's helpful. So yeah, and really those footnotes. I know we put a lot in ours, but like they might be like, this doesn't matter to me. It matters to the CPA, so make sure you're providing as much of that PDF to the CPA.
Hmm. Now, looking at that cash distribution again. So let's say Jordan gets $7,000 in year one, but that K1 that he gets in, call it March, shows a loss. How can that be true? And as someone that is not familiar with what a K1 looks like or what any of those terms mean, how can they wrap their head around that?
Yeah, no, this is a good question. I mean, even clients that I currently work with that have invested in other syndications still ask this question, right? So it's a common one, and it's also so in regard to there's two different types of cash in regard, or I should say, income for the standpoint of a business. We have cash flow, and then we have taxable income, and they're not the same thing. Can they get close? Can they potentially be the same? Yes, but really, cash distributions is based upon the cash flow of the business for that current year. Taxable income takes into account the tax rules. It takes into account non-cash deductions like depreciation, and so Jordan gets that 7,000, and that's because the property, that syndication you're investing in generated enough cash flow to distribute that money. And then I'm going to add a little bit more just because of reading the articles that SNS put out about the different properties, which are really well done. They talk about like the operating piece, but then also the capital expenditures, right? And so what a lot of times you have to differentiate the two when we think of cash flow, right? And so it's the cash flow from the operations is producing enough to create that $7,000. But when we have the cap X, some of that is going to help reduce the taxable income as well. And so now all of a sudden, that's why they're not going to line up. Or your second year, we have depreciation from the original purchase that's also going to help. So there's multiple moving pieces. And so, yes, you could still receive $7,000 and still get hypothetically a $7,000 loss on the K1, but yes, they're different, but they're supposed to be different because of the two different types of income.
Hmm. What is bonus depreciation? That's a term that gets thrown around a lot. How is that playing a role here?
Yeah, yeah. Um, so bonus depreciation falls under. I'm gonna break down depreciation in general. Uh, so pretty much depreciation is when the IRS says, "Hey, we give each asset a certain life." And so for residential properties, it's 27 and a half years. But with it, when you buy property, you have, you got land, you got the building, you got other things, right? Well, um, so if the IRS says, "Hey, this is how long the life is," and it's just determined by the IRS, we can't make any of those numbers up. So that 27 and a half years, we just have to be able to depreciate over 27 and a half years. But current law, and this was for 2025 and 2026, through Trump's one big beautiful bill he passed, he brought back bonus depreciation. And I'm just bringing that up just because you might have saw in 25 these much bigger losses than you did maybe in 24 or 23, and then the bigger bonus depreciations were back in like 2020, 21, et cetera. But bonus depreciation is saying, hey, we got a 27 and a half year, we got a 15-year and a 5-year, again, determined by the IRS. And the IRS is like, hey, anything that falls in the 15-year or the 5-year, we're going to allow you to take a certain percentage more than what you normally could. And so the reason it's bonus is that normally you'd have to do, let's just say over 15 years or over 5 years, they're saying, hey, you can take more. And so the current law allows for 100% bonus depreciation, aka you can take 100% of anything that falls in the 15-year or the 5-year immediately versus being able to take it over the life of a 15 or the life of the 5-year.
Mhm. And is that $7,000 cash distribution, is that taxable? I mean, like, is Jordan paying taxes on that?
In theory, no. I can't always say, but that's where basis comes into play.
Mhm.
So I would say, if we do simple math, he puts the 100,000 in, and let's just say he has a $10,000 loss. That 7,000 is not going to be the distribution is not going to be taxable because your basis is how much did I put in, how much loss did I have, and how much distributions. And so as long as your original 100,000 doesn't show negative, then all distributions are tax free. Now, in some cases, debt can be added into that, which is showed up on your K1 as well. But you'd want to talk with your CPA about that piece of that.
Mhm. What's a cost seg study? You mentioned
Yeah.
that earlier.
Yeah, yeah. So I talked about the 27 and a half, the 15 and the 5. Pretty much we're breaking those out. So, as I was preparing, I was trying to think of a very simple way to explain this. And this is, I think my kids would even be able to understand this. So think you're going out trick or treating. By the end of the night, you have this bag full of all different candy, right? And some kids, some people might come and say, "Hey, I'm going to take all the candy and put them into different categories." And so I got my chocolates over here, I got my gum here, my suckers over here. And so pretty much, if you think of that, you're pulling little pieces out and separating them, right? Well, that's what a cost seg is doing. Is I'm coming through, taking a building, and I'm trying to say, okay, what falls into the 27 and a half year, the 15-year, and the 5-year? And so some easy examples to think of for this is for a cost seg is what's permanent building or structural, such as the walls, the certain electric, certain plumbing, windows, roof, things like the structural, that's going to be your 27 and a half years. Your 15-year, best way to think of that is land improvements. So sidewalks, parking lots, landscaping, things like that. And then your 5-year is going to be things that I can remove and reuse. So appliances, kitchen cabinets, countertops. You can get as detailed as like blinds, ceiling fans, and then on top of that, your carpet and floating floors. Now, I don't know if I'd reuse my carpet in that, but according to the IRS, it does fall in that 5-year category. So yeah, that's how we're breaking it out. Again, think of the trick or treating, the bag. I'm pulling them out and separating them and then I'm putting a cost to them.
Mhm. Yeah, that's a really good example, actually. Um, I'm thinking now too. Earlier, I mentioned when highlighting Jordan's background that he is not a real estate professional, and I think that's important to point out. But I don't know if the listener understands why. So, can you help the audience here understand why that would matter when Jordan does have a high W 2 income and he's wondering, oh, I have this loss. Why can't I put that against my high income and lower my tax bracket. Can you walk through that a little bit?
Yeah. Yeah. So this might be the most complicated, and I'm going to try and break it down as simple as possible. And then also at least give some ideas where it's like, hey, maybe you should talk to your CPA more about this. Just because there's actually three different rules for an LP that they fall into for losses. We have basis, at risk, and passive activity rules. And so basis, again, that's that 100,000 I put into, less distributions, less in or losses. But if you do have income in one of those years, it does increase it, right? And so as long as that stays positive, then we can take losses. Well, we go to the next one. So, and I said it in the same order: basis, at risk, passive. And so if you have basis, perfect. We go to the next step: at risk. Is Jordan economically at risk for the amount? And so that's where, where debt comes into play, or him personally. There's a lot of different moving pieces on that. But then the third one, and so most of the time for the syndications, you're going to meet that one. But then really it's the passive. And so from passive, you're trying to figure out, hey, do I materially participate in in this building or this rental? Most LPs are not, so now all of a sudden, can you take the losses because I'm passive? And really, what it says is, if my income is too high, I can't take any of those losses because I'm not materially participating. And so, the but sorry, I lost train of thought. But the IRS generally treats rental activity as passive, kind of no matter what, unless the taxpayer qualifies as that real estate professional. And so that's where, when I was saying material, that real estate professional, and that's a key term that pops up a lot. I think we're going to cover that here in a little bit. But um, so for most LPs, specifically in Jordan's case, he's going to have this loss that is carried over.
hmm So, what is a real estate professional, though? I mean, is there like a certain amount of hours you have to spend, or how do you get that designation?
Yeah, yeah. No, this is really good question, and there's lots of ways to potentially qualify. And so, for a real estate professional, you have to have a minimum of 750 hours per year, which is roughly about 14 and a half hours per week. Um, and on top of that, you have to have more time in the real estate industry than any other industry. So for me, for example, this is a lot of people are like, oh, you talk real estate all the time. I'm actually in the financial industry. So like none of my time as a CPA counts towards that real estate professional. And so the key is, Jordan, he's working a W-2, and let's just say it's a typical W-2 of 40 hours a week. So he has 2,080 hours. Well, you have to meet the 750 and more than any other industry. So to be able to qualify in his situation, he would have to have 2,081 hours in real estate to be able to qualify, because that's greater than that 750 hours. And that's where now all of a sudden, if you qualify, those losses from the syndication potentially can be taken to offset W-2 or other income. And I'm saying potentially because it's not easy to say it applies to everyone. But for the most part, if you qualify, there is a good chance you can take those LP losses to help offset W-2, other gains, let's say stock gains, retirement income, anything like that. Yep.
hmm And so, in this case, Jordan, he has his high W-2 income. He gets that. He gets his cash flow, the 7%, $7,000. The K1 does show a loss. He to confirm, he cannot write off that loss against his income because he is not a real estate professional.
Correct. Yeah. So in Jordan's case, he would have suspended passive losses. So he met the first two. Remember, we got three different types of rules. He met the first two, so we're at the passive, and now all of a sudden those losses are suspended. It does not mean they disappear. It just means they get carried forward and potentially used against other future income. Well, what other future income could that offset? Well, let's just say in year 4 of this syndication that we're talking about, it has income. Well, now all of a sudden, those suspended losses could offset that income, or in the year of sale, it could offset that. Another example, let's say Jordan, before this investment, had two other syndication investments. and those are bringing in income. You can start to offset other similar type of income with those losses. And if not, they're suspended until the asset's either sold or you're out of the deal. And so those are keys. You just don't lose them, and that's where it would be a great, like, when you have those losses, you should be talking with your CPA to say, hey, like, what should I be doing to use these? Or, hey, I know this property is going to sell in 5 years, or I'm looking to get rid of this investment over here. Like, talk to them, because there can be some massive tax planning opportunities with those suspended losses when they hit. I'm going to use one just quick example that I had actually is in regard to a family member of mine. They had this was back in 2008, I believe it was, and they had a rental property. Well, he was a high earner and couldn't take any of the losses. He eventually accumulated about 300,000 of losses. Well, by in 2015, we'll call it, he sold the property. It freed up all 300,000 of losses. And what we ended up doing for a planning is ended up selling some stock, or did, produce some other income where we could keep the brackets really close. And so, like, that's where it's important to talk with your CPA, because if you have accumulated passive losses, again, you do not lose them. But if you have them, they could be used sooner, and so you could try and time it with other investments or anything like that. Because here's my philosophy: I'd rather keep more money in your pocket today and keep things investing, so that way you keep getting more money, making more money. And so in Jordan's case, knowing that he has these suspended losses, we would be talking through, hey, what other investments do you want to do? Oh, you have this over here you would like to sell. Perfect. Let's time that up. Things like that. And so yeah, so it's really key to be having those conversations with your CPA as you build up those losses.
Hmm. And you mentioned that when you do eventually exit from the property, so in Jordan's case, we're going to say that the deal is it's a 5-year opportunity. They're going to sell the property in year 5. And I guess maybe he's been kicking some of these losses down the road, maybe not using them up till this point. But what sort of tax items might Jordan see, and what should he consider now that we are approaching this sale? And how would those depreciation related expenses or taxes play into this?
Yeah. Yeah. So when we approach a sale, specifically in what would continue in the real estate industry, you're going to have, capital gains. Capital gains is, in theory, I bought it for this, I sold it for this. That difference is capital gains. But then we also have recapture, or the true term is Section 1250 gain. And the reason I bring up, just say that section, is you will see that on the K1. And so Section 1250 recapture is saying, hey, we have to add back depreciation. The IRS is like, hey, we gave you this benefit over the last so many years. We want you to pay it back. And so the reason it has to be separated is that the recapture has a different tax bracket. So capital gains has its own tax bracket. Recapture has a separate one. Now, for high earners, that actually could be a benefit, because it's capped. The recapture is capped at 25%. But you got to take losses at a potentially higher rate. And so for high earners, there's actually a lot of benefit where you can almost eliminate a certain percentage of tax because of depending on where the brackets fall. Now, if you're, for whatever reason, in a lower tax bracket, you would just pay your ordinary rates at that point. So when we think of the K1, there's going to be, and preparing for the sale, there's a line item that will say gain. That's going to include from what we bought to sold, and then that difference is going to be the recapture. And so the recapture is included in the gain, but then that 1250 line is what is going to be removed from the gain. So you got long-term gains, and then you got a recapture. And so it's one where, you know, how do you plan for it? I think when you as you're looking through the financials from the syndicators, you're trying to see, okay, they're projecting this amount in depreciation. They're trying to project this. And so with your CPA, you could probably get pretty close knowing that that year is coming because you wouldn't see the K1 till March of that following year. And so you could still get close by saying, okay, we sold it for this, we bought it for this, here's the depreciation. So we could now plan for that.
Hmm.
Now, in a year of sale, that's where, hey, let's just say you didn't have any other investments. Well, those losses now free up because it's most likely the final year. And so they automatically free up and they're going to offset ordinary income, which is like your W-2 or anything like that. Which again, capital gains is at the better tax rates, but your losses are going at the ordinary. And so it's going to be a much better. And so again, a good planning opportunity. The other things just to keep in mind, just because I've seen these questions come up, is make sure you're paying attention to the state reporting. So let's just say I don't think we covered it, but let's just say Jordan lives in Florida, right? And Jordan never had to file an Ohio return. Well, now all of a sudden he might have to file an Ohio return because there might be a tax associated with it. Definitely consult with your CPA on that. I can specifically say from the SNS standpoint, we're filing where the assets are located. We're filing for those taxes, and usually you have a credit on there, aka the business is paying for it, but you could get a refund from that situation. That said, if you're not getting state K1s such as SNS, you'll really want to be talking with your CPA. Hey, I know this property is located in Georgia. And so that way you're taking care of the proper states from that standpoint. And then really the last piece in the year of sale is most likely it's going to be a final distribution. And I would say most of the time your distribution is going to be slightly less than the gain showing. And if we think about that, it's kind of reversing from the year one. We were getting distributions, but our losses were less. Well, it's that depreciation, right? We're in year one, we were getting more depreciation. So our losses looked less, but we were still getting distributions. Now at the final year, we have to add back that depreciation. And so our distributions could be, I'm not saying it's guaranteed, but should be less than the actual gain on there. And so it's one not to worry if, hey, it's in his case for 100 grand, let's just say it's 20,000 more, and it's just that depreciation add back.
Hmm. When looking at it, this is maybe more high level, but just looking at a syndication as a whole, you got your general partner and your limited partner. They're coming together to own these properties collectively. How similarly or differently do those taxes flow back to the general partner versus the limited partner, or is it the same?
So it honestly it depends
Hmm.
because I've seen many different structures from a GP to LP situation. But in theory, so what I mean by that is it's the operating agreement. And so when you're signing, the operating agreement, definitely read through the GP LP splits and everything like that. That's a critical piece. But when we talk about, let's just say it's more of a traditional, I'll call it traditional way, is you got the GP split and LP split. When it comes to the income and the gains, it's going to be split according to those percentages. So if it's a 50-50, for example, or a 70-30, it would go, let's just say 30% GP, 70% LP, and it's just split. So what I'm getting at is from a operating cash flow or taxable income, I should say, I apologize. The taxable income after depreciation, whatever that net is, it's just split accordingly based upon those percentages. It can get very complex, and I've seen extremely complex ones. But it's good just to read through how are the splits actually happening. And again, that's where it's going to change from the cash flow, aka the distributions versus the taxable income, because a lot of syndicators aren't going to be taking distributions because they're not getting that preferred, but then they're really paying on the back end for the gains, right? Because they're not receiving any of that income up front. They're receiving it for taxable, but not from the distributions. And on the back end, they're actually claiming a lot more of that gain where you're not having to because you've been receiving that preferred distribution.
Hmm. Yeah, we could probably do a whole nother episode talking through deal structuring, which we did do at one point on this channel. So go check it out. But for our deals specifically, I want to go back though to when Jordan was initially evaluating this opportunity. So he's looking at this deal, he's looking at the offering memorandum, deciding, do I want to make this investment? If you were advising him, what would be the three most important questions that you would hope that he would go to his CPA and ask prior to making this investment, or maybe just three things that he should keep in mind from a
Yeah.
tax standpoint?
Yeah. So, taxes are important and you need to consider them. But I also don't believe you should be making decisions on investments directly on the tax side. There's a lot of other things that need to prioritize in regard to the tax. Don't get me wrong, it's still important, but and maybe I lose a few clients saying that, but it's one where uh, really the first thing, and I know it's not tax, is does this deal make sense financially, right? That's got to be the first one. But from a tax standpoint, I would be the saying like, hey, this is my first deal. Well, can I take these losses? Because if you're not invested in it yet and you would like to take losses, now all of a sudden we can start having the conversations. How do you hit the real estate professional? Um, maybe you should, were you thinking about another investment? Because like if we can time some of those up where now all of a sudden you could take some of those losses to help offset, that'd be a perfect example. So it'd be being proactive and saying, how can I take these losses? And now it might mean the investor has to do a little bit of work, or maybe the spouse, depending on the situation, has to do a little bit of work. But like by having those conversations, at least now can I take them or not? I think the other thing would be is like, um, I think this, going back to that state tax is an important one because I've seen where, unfortunately, I've seen it too many times. Someone's investing from Florida or California, and they just, now their CPA might charge them more to file another state, and that might affect like, well, should I have done that or not? And so I think talking through the state filing obligations is an important one. And then the last one I would say is just, and this is being more proactive, is hey, if they hit these numbers they're talking about for the gains, what does that look like for my future? And the reason I bring that up is, let's just say, in 5 years, Jordan is to the point where he's going to retire, right? And now all of a sudden, when he's in retirement, is he taking IRA distributions? Is he taking some other things? And so being proactive and saying, okay, what does 5 years look like for me? Um, and talking through that with your CPA, I think are important. I think there's some other things that, if you have other investments, you could be having some other questions or conversations. But if it's just your first one, I think getting to know as much as possible from the tax standpoint is critical. I'm a big believer when you sign your tax return, you're just as liable as the CPA. And so you should have a general understanding what's going on. And so just ask as many questions as possible.
Hmm. And with a, oop, go ahead. Sorry, I think I cut you off.
Nope, you're good.
Okay. With a limited partner evaluating operators like SNS, what sort of things do you advise an investor to look for in those general partners uh, on the tax side? Is there anything that they can look for that they might not know just intuitively? I mean, sure, you could look at the returns and the operations, but on the tax side, what's important?
Yeah. Yeah, I mean, if it would be, and I've never asked this before, but like if you could get a K1 um, from a prior deal, I think that's important because I see too many times where, so on page one of the K1 that you get, the bottom left is the capital. That's really crucial for your CPA to track your basis. And so Are they filling that out? Are they putting the debt on there? Like try and have your CPA or you look at a prior K1. Again, that might be more difficult to truly ask for, but I think it's worth trying to ask because now all of a sudden, if you're able to get that and just be like, okay, this is what they're reporting, you might get more comfortable that like, hey, like their CPA and the syndicators are doing their jobs to the best of their ability. Because if you're seeing lots of statements, seeing other state returns, like those are critical. Now, is there a risk for you as an investor? No, that's where the LP comes into play. Is you're limited, right? But specifically with the IRS is what I'm getting at. But if you could get one, that would be outstanding. Just so you could say, here's a great example. I just ran into it twice this past year. Is the K1 for a client who's been with a limited, or he's a limited partner with another syndicator, and they decided to stop reporting the capital accounts. Well, based upon what information I had, that means they had a suspended loss, and he ended up losing $7,000 a refund in this situation. Well, we went back to I gave the client questions to go back to the CPA or the syndicator, and all of a sudden, they talked through it, and an amended K1 came back from it, and now all of a sudden we were able to keep things moving. And so it's just one where how if you can get a prior K1 again, I think it allows you and your CPA to be like, okay, we're going to have enough information. If you can't, then that's where I would say it's going to be very important for you to, as an individual, to track every dollar you put in, every dollar you receive, etc. So that way you can keep track of that. Because like in the client's case I'm thinking of, there was just no way we were able to get him that 7,000 without more detail from the syndication
Hmm.
situation.
It was there was a term you mentioned earlier that I think I should have asked about, but you mentioned basis. Can you just explain that in layman's terms?
Yep. Yeah. So basis is, let's use stock because I think more people can understand stock. So if I buy Apple for $100, that's my basis. Now my basis doesn't change, and so I always have that $100 basis until I sell. Well, in a syndication, my basis is I put money in. So in Jordan's case, $100,000. My basis starts there. Then my basis goes down for any distributions. It goes down for any losses. It goes up for any income that the K1s report. Then, for basis purposes, in a partnership, which is what 99% of syndications are going to be, you also get to take into account debt. Now, you still want to talk to your CPA about that, but debt is now included. And so, basis, as long as basis is less than zero, then that's that first rule in those three categories. You get to take that, you get to move to the second category. But also, if you have zero basis or less, now distributions are taxable. And I've seen this and actually had it happen a couple times this past year where they removed the debt from the K1, and now all of a sudden we weren't able to take the losses to help offset. And so basis from the IRS standpoint is one of the most important things you have to track. And it's not the syndication's level's responsibility. The IRS will always say it is the individual's level. So, yes, anyone that's invested with SNS, you'll see that we do have basis schedules on there, but it's not SNS's responsibility or the syndicators. We do it more just to help out, but it is your individual responsibility to make sure you're tracking basis on that. Unfortunately, I've seen too many times where the IRS has reversed things because someone didn't track basis properly.
Hmm. Thanks, Phil. Yeah, I got one more wrap up question here, and then we'll get you on up and out of here. But there was one that I was thinking of to kind of wrap this up, and it's just more general. What is the most like common, or maybe you could list a few, but misconceptions that you hear from limited partner investors? I'm sure you probably get a ton of questions. Is there anything
Yeah.
that comes to mind?
Yeah. the K1 loss means the deal lost money. Again, cash flow versus operating income. It's probably most likely depreciation.
Hmm.
I think the other one is cash distributions are taxable. Not necessarily. Again, we got to do the basis. And most of the time, if you just take your 100,000 divided by seven, that's how many years of distributions. Yes, we got losses and income in there, but like in theory, that's how long you have. So distributions are not usually not taxable. Um, depreciation makes taxes disappear forever. A lot of people think, hey, we took this bonus. They understand bonus depreciation, they understand depreciation, but now all of a sudden you don't have to repay it. That's the recapture piece. It's like, hey, we got to prepare for, that sale, and then all investors in the same deal get the same tax results. That's one where I think, again, the business reports the taxable income, but every individual is different. And so, and the reason I bring this up is I've heard so many times, hey, my buddy invested in this. He's able to take the loss. I'm not. Why is that? Right. And so I think it's just one where don't, you don't really want to compare yourself to others because everyone's situation is truly different.
Hmm. Yeah. Well, Phil, this was great. I did not need a second cup of coffee. That's a win. And I want to thank you for taking the time here. And I did want to give the opportunity for you to, here at the end, where can our listeners and viewers find you and your business?
Yeah, yeah. So we're located in Cincinnati, but we work with clients throughout the United States. And if you want to get a hold of us, you can go to our website. It's hwcpa513.com, or you can call us at 513-563-1444. And then just let them know that you referred from SNS, and they'll get you in touch with me.
Cool. Well, thank you, Phil. I'll make sure to put all those links in the description here too. I appreciate you taking the time.
Yes, thank you.
Talk soon.
Yep, bye.